Hi, I'm Mark Persano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we hope that you had a nice little break. Hopefully the kids are having fun if they still have their break for this week. I know mine do. And now we get to go into the EIA show. What are some of the things that we saw coming up as to, driving, jet, as we've been talking about. And we'll break it up into our normal, which is the overview in the beginning, a deeper dive on refined products, and then going global in the third part. So just to kick it off, we always like to look at what has changed in the curve, where have things shifted in general. So then when we look, you can see that realistically, it's only been in the front few months where you can see where the drop is, as we're still above 55 going out till August of next year. And you've actually seen some of the recovery coming on the back end of the curve, really holding above 50 going through the remainder of the cycle. Now, I've given, it's really not all that relevant past 2 years, but we still like to look at just kind of where things sit. What are the expectations now that we're on the other side of the OPEC meeting? There, as we've talked about in our Frac Spread show, what are they looking to do? How is that shifting? So now that we're going through, now it's what happens with storage, what happens with crude, what's happening with product, because there's the viewpoint of reopening, everything's great, vaccines galore in the US, but when you go abroad, it's a little bit different. Canada's coming down, having another type of lockdown. We have issues that remain in Europe. We have India setting records in terms of new cases and the issues that continue within Asia. And again, these are things that are going to impact the total amount of product that is available in the market, and then also the amount of crude that is competing to find a home, as we'll talk about in segment 3. So just looking at where we are, so we had a draw of about 3.52 million barrels. You can see it was really driven by PADDIII, PADDIII. When we look at it on the year over year, you can see that year over year we're still 13.9 million over the year over year and 10.9 over the 5-year average. What's going to happen going forward is where are exports versus imports, because we still have a lot of imports that are still waiting in the wings, but we also did have a nice increase in U.S. exports across the board. Now, the reason why we'll get this big surge towards the end and the beginning of the month is when is it signed on? So when does it actually push off? Because typically you can fill at any point in time within a month, depending on how it's structured. So when you look at where they push off from the U.S., that's where you can kind of get some of this lumpiness, which we did see, and helped pull down some of that storage in PADDIII, as we still have a fairly elevated, within reason, refinery through utilization rate. So that's where we saw some of the biggest increases. Then when we look at PADDIII, we had an increase of about 2 million barrels. That was really, we had a decent increase in imports. We will be elevated in imports, but again, this is going to be kind of that cyclical move. And then when we look at production was down 200,000 barrels a day. That's something that's going to come back and forth, just in terms of the reorganization of how this is calculated. And then this is something that's going to bounce back once we get towards the end of the month, as we continue to see Frac Spread Count activity increasing and production increasing through the end of the month. So just to go around the world and back, when we look at stockpiles rose about 1.3 million barrels week on week. You can see when we look at land storage with the U.S., ARA, Japan, teapots were back to that 5-year average. Same with west of Suez. East of Suez is continuing to push higher. You can see the current versus the 5-year average. We continue to go back. Current stockpiles are higher than the 2015, 2019 average, as we continue to see this moving higher. Now, this is land storage, which continues to push up. And then when we look at floating storage in segment 3, you're going to see that we also see an increase in floating storage. So we have an increase in land storage, we have an increase in floating storage, which just means that we have a lot of crude in the market. And we will have more coming to market at the starting in May, when we have about 2 million barrels coming back over a 3-month period, or I should say, more than that, just given what OPEC is doing and then what Saudi Arabia is bringing back to market. So this is going to be something to watch, and they've talked about how they can turn on a dime and cut that back down. Which, if we start looking at Asia and some of the data points coming out of Asia, that's going to be one to watch. Where are they going to slow down some of those increases, because we do have some of these impacts on demand. Now, looking at road fuel, you can see that we've North America continues that slow grind higher. Europe is flatlined. Asia is starting to come down, especially with China. And this is what we keep talking about with Asia, China, Europe. We keep seeing this slowdown in general, but it's a slowdown relatively speaking, because we're just not seeing the pace of acceleration that I think the market was really expecting. And when we look at North America, and now we look at Canada, what's happening in the U.S. The U.S. is continuing to recover, but again, it's still slow. And we'll talk about that in segment 2 in terms of some of this normalcy coming through, where Europe and Asia continue to remain under pressure, especially with the slow vaccine rollout. And then when we look at China, the issues that continue to arise. They did have their holiday this weekend. And even though there was more travel, there was way less spending, and that's something that we'll talk about in the econ shows going forward, and some of the other data points as we start to see some of this come through the refined product side, because we're seeing a decent increase in exports, and it's really not. It's a mixture of an increase in exports because we're just not seeing the same type of demand that I think they were hoping for on the internal level. So turning back to the U.S. Here you can see kind of where we sit versus the 29-year average. We're starting to flatline here, and this is, how quickly we can draw down is going to be driven based on what does imports look like and what a refinery run is going to do. And when, last week we talked about how there was a really hard pivot away from distillate into the gasoline pool, and that mixed with the big increase in imports, all of a sudden you saw this big spike in total storage. So when we look at it from PADDIII, we still have those seasonally adjusted highs, but we're starting to roll over a bit. This is a mixture of exports increasing, imports remaining fairly low, and an increase in utilization rates, which pulled through more oil. Again, we still have a lot of work to do, just given the amount of crude that sits in storage. Because when we look at the average, so PADDIII is 37.1 million barrels over the year over year and 41.7 million over the 5-year average. Just to put into perspective just how far over we are when we look at PADDIII. And PADDIII is really where that we meet with the international world in terms of what do we export, what do we import. And given, PADD1, PADD5 also import, and PADD2, but PADDIII is really where we see a bit more of a balance. So again, it just speaks to some of the softness in the global market. When we look at Cushing, Cushing had a small draw. We're starting to flatline here. When we look at Cushing in general, we're still about 2.9 million below the year over year, 7.1 below the 5-year. And it had a draw of about 730,000 barrels. Now, this is something where as PADDIII continues to normalize a bit on refinery throughput, that'll help pull down some additional Cushing. We did get that increase in exports, which helped, again, that pull down. The problem that we see here, those exports, the exports are the ones where we continue to see those problems on seeing or trying to get to some sort of balance, especially in PADDIII. So then when we turn to the import side, as we keep talking about it, so the imports of crude increased by 117,000 barrels a day. And as we had highlighted, it was really going to be driven by PADD5. So PADD5 is back up, it's up 613,000 barrels a day from year over year. That will start to pare back, but it'll still remain elevated versus the year over year and the 5-year average, just because we do have PADD5 reopening. There is more driving. So that's going to pull through some more crude as they look to build out some of their products in general. So then when we look at PADDIII, it was pretty stable. That's something where when we look at floating storage, floating storage is starting to increase, which just means that we're going to start to see some of those pull-throughs, where PADD1 and PADDII were fairly stable. So there really wasn't too much of an increase. This is something where we think there'll start to be a little bit more activity on the import side, especially given where we sit on refinery utilization rates. Now, speaking of run rates, we're at 84%. We had an increase of 0.1. We thought there might have been a little bit of a decline, just given some of the issues that happened in PADDIII. But again, it's all a matter of when do they go down and do they come back up prior to reporting. And as we were saying last week, PADDIII had that increase, and PADDIII is going to remain elevated as we go through really into May and then into the summer driving season. We still think that 83 to 85 is kind of that comfortable move, something closer to averaging between 83.5, 84, especially as we go through April. And then when we start getting into May, are we going to see an acceleration? Where do we sit on gasoline storage, gasoline demand? That's going to really impact the biggest overhang is going to be distillate, because we still have a lot of distillate in the market, internally, externally. And that's going to limit the amount they can come back, because if they can't get rid of or use the disti, then it's going to, that's going to limit the amount of gasoline that they can actually create. So the run rates is going to be one to watch, and it's something that we keep talking about being fairly low as we go through April and into May. Then when we look at implied demand, as we were saying, there's always those timing components, because we will get another spike in gasoline demand this week. It's all going to be a matter of when is it being recognized, when is it being pulled into the system, because we did get a spike of activity as we saw last week with Holy Thursday, Good Friday into Easter. For some that was the end of vacation. For some, that was the beginning. So again, that's going to be something to watch, because gasoline demand will be lumpy, but again, it's going to have a pretty steady move once we get to this component, which we'll talk about in segment 2. Distillate had that pull back about 449,000 barrels a day. We're now going to sit closer to this number, just because, again, heating oil is starting to decline. It's just as we get into April, then into May, again, that residual is just going to go away. Jet, again, as we keep talking about, it's going to be fairly stable between about 1 million, probably 950,000 to about 1.3, 1.4. And now we're going to work within that level, as we've been talking about with passengers and that competition for activity. Propane remained fairly flat. That's something that we think will be fairly stable, maybe have a little bit of a walk back, but just because of heating needs. But again, that's something that we think will be fairly strong. Then when we look at movements, April loading shipments of clean fuel from Asia to the Americas increased to 70,000 tons as of Tuesday, up from 35,000 tons a week earlier. So again, the Asia to Americas is going to continue, which will cap some of our exports, but also bring in some additional capacity into the U.S. European imports of clean fuels from India were well down year over year, because again, Europe is having their own issues and they're trying to manage their total flows. And then when we look at what's coming into the U.S., well, 2 tankers hauling about 140,000 tons, 1 cargo diesel, other jet arrived in March, which was down. So we're starting to see some of that normalization on the diesel side. U.S. imports of diesel from Europe recovered to more than 1 million barrels in the 7 days through April 1st, while gasoline shipments slipped to a 4-week low. And we'll talk about, U.S. gasoline imports rose to the highest, U.S. East Coast gasoline imports rose to the highest in a decade. As we were talking about, we had that flow, that essentially that armada that we've been talking about coming into the U.S. There's still more behind it, but that initial surge is now gone. Now we're going to see a bit more normalcy. It'll still be elevated, but again, on a normal level, which will continue, while weekly diesel arrivals from Europe rose to 147,000 barrels, which is actually up. So we do have a bit more diesel coming through. That'll keep our imports elevated. And then gasoline imports dropped to 359,000 barrels a day, which is the lowest weekly flow since March 4th. Compares with the revised 364,000 the previous week. So again, we're seeing some of this kind of stability coming through, where it's down, but week over week, but it's still very elevated when we look at the historics of this point in time. So then when we look at floating storage on the crude side, we're back to the 5-year average. This is something where, just based on where flows are, we'll still see a fairly healthy amount, and by healthy is obviously relative, because we're still, but it'll still be at the lower end of the 5-year average. But as we do have the, some normalcy in refinery run rates, they'll have to keep some of this fairly stable. So this is where we will see some of this elevation coming into the next few weeks. And it all comes down to imports. So we're still very low. We're at the low end of the cloud, but we're going to start to see this, creep a little bit higher, especially given on what they're targeting, how are they looking to increase their runs. And that will, again, kind of keep this elevated. And then also the target of product they're trying to make will adjust, because if they want something to go through the coker and increase the full suite, you'll have to increase the heaviness of your feedstock, which is going to come off the coast. So then when we turn to PADDIII, as we were saying, it was going to, we still think it's going to maintain above the 5-year average. Right now, we're pretty much tracking the 5-year average, and it's something where we don't think it'll come back down, but again, we wouldn't be surprised if it just continues to track it, but average above that 5-year, just because we do have a very large, a lot of activity. And now Canadian crude production is back to pre-pandemic levels, which just bodes well for a lot of this crude coming into our market, specifically PADDIII and PADDIII. When we look at refinery utilization rates, as we were saying before, once we got to this level, we thought we were just going to go sideways. And here you can see is that sideways move that we've been talking about. We can go up and down, 0.5%, maybe anywhere from 0 to 0.5%. That's something that's going to be, again, just a matter of timing. We do know that there are some downtimes that's planned starting now. So again, who comes back, who comes off, and we're just going to sit here. When you look at that 29-year average, you can see that there's a nice gradual increase in activity as we go through the summer months. It's just we don't think that we're going to hit those total levels as we keep talking about with just some of those impacts in general when we're looking at just activity and what does that activity look like as we, what sets that activity? Well, refined product demand. And in the next segment, we're going to go through that refined product demand and where do we see that going as we head into the summer months.